Peter Schiff, CEO of Euro Pacific Capital. Now, Peter and I discussed Europe, the Fed, and if rates would increase in 2015. But first, I asked him about gold and what the massive drop in prices tells us as a market signal. Here's what he had to say.
I think the reason that gold has gone down is because so many people don't understand what's going on in the global economy. They believe the Fed solved the problem. They don't understand that the Fed made the problem worse. They're confusing a bubble with a recovery. They think the Fed can raise interest rates and end QE. It can't. They're all in. They're going to do QE4. They can't raise rates without precipitating a worse financial crisis than the one we had in 2008. And when people figure out what's actually going to happen, when they give up this fantasy and start to accept reality, then you're going to see a huge increase in the price of gold, because people have prepared for the opposite of what is going to happen. And people are going to have to reevaluate and reallocate their resources, their portfolios, once they figure out how wrong they were. I think people are more wrong now about the true state of the U.S. economy than they were on the eve of the 2008 financial crisis.
Now, commenting on the Fed's zero-rate policy, boom-bust regular like yourself, Jim Rickards, recently said that, quote, "There's nothing monetary policy can do about it. You can't fix a depression with liquidity. You can only do it with structural changes." Do you think that Jim has a point?
Well, he was right. I mean, the reason that we need a recession is because the government so screwed up the economy with cheap money in the first place. So we have all these malinvestments, we have all this misallocation of resources, and the market needs to correct that. It needs to sort it all out. And during that process, you're going to go through a recession. Just like if you're high on drugs and you quit taking drugs, you go to rehab, and your body has to flush all those drugs out of your system, and you go through withdrawal. That's part of the healing process. So the recession, unfortunately, is the part of the process that we have to endure to fix all the problems that the government created. But instead of allowing the market to repair the damage, the government does even more damage. We continue to inject more of this monetary heroin into the economy to delay the day of reckoning. But now, because we expand the problems, we make the problems bigger, the ultimate collapse is going to require that much more pain to solve the problem, because we've delayed it for so long and made it worse.
But the Fed's going to keep rates at zero next year and not hike, correct?
Well, I don't think that they will. I mean, if they do raise interest rates, they're not going to be able to raise them for long, because we're going to go right back into recession. And what does the Fed do when the economy's in recession? They cut rates. In fact, if you look at the economic data that's been coming out recently, most of it is bad. But all the bad news gets ignored, or they rationalize it.
Let's take a trip across the pond now and talk about Europe. In Europe, sovereign yields are at record lows, and some people are saying that German yields could go lower than Japanese yields by the end of next year. So are you bullish on European sovereign debt?
Well, I'd have to be bullish on the euro to be bullish on the debt, right? Because you're ultimately going to be repaid in euros. And so, no, I don't think any of these sovereign debts should be bought. Is it possible that yields can continue to go down? Sure, of course. I mean, they're already ridiculously low, so I can't say that they're not going to go lower. But I do believe that you're going to have a blow-up in Europe. I think that inflation is headed a lot higher. And ultimately, they're not going to be able to say that we need more inflation, and eventually they're going to have to put on the brake. I just think that we're going to have an even bigger inflationary problem than Europe, but I don't like either currency. I think the euro has a lot of problems. I think the dollar has a lot of problems. The yen has a lot of problems. That's why I think people should be buying gold. I mean, maybe the Swiss franc could have been a safe haven had they backed it by gold, but instead they're just backing it by the euro. So the Swiss franc, unfortunately, for the moment, is no better than the euro, although I think the one thing the Swiss franc has going for it is at least you know that you have a franc. I mean, if you own the euro, if you have a bond denominated in euros, do you really know what you have? I mean, what if the eurozone disintegrates? What currency are you going to own? Are you going to own the Deutschmark? Are you going to own the lira, the peseta? I mean, the drachma, some combination? I mean, who knows what you got? So at least with the Swiss franc, if they get smart eventually, they can sever the tie that they have with the euro and not try to have this, 120 peg that the gold referendum might have forced them to abandon. So at least with the Swiss franc, you got francs. But I wouldn't want to buy government debt really of any of these major governments. I don't care if there's, you can make a little money as some greater fool pays an even more ridiculous price than you did. I would much rather buy equities around the world, and there's plenty of equities that still trade at very low PEs that have good dividend yields. I really want to own real assets where you have central banks all around the world promising to create inflation. You should believe them. That's the one thing central bankers can do. They can't create economic growth, they can't create good jobs, but they sure can create inflation. They can destroy their currency, they can make prices go up, and people need to protect themselves from that.
That was Peter Schiff, CEO of Euro Pacific Capital.